Well, why don't we start recording then?
You bet.
I appreciate your time. Like I said, Eric, you are the partner and senior portfolio manager at Ninepoint Energy Fund. What is Ninepoint Energy Fund?
Yeah, so we're the largest energy fund in Canada. We manage about $1.35 billion, depending on the day. We were the number one energy fund in the world last year. And we seek to make money for our clients, which are largely Canadian retail investors who share our view, and that is we're in a generational opportunity because of energy ignorance, which I define as the lack of knowledge of how oil is used and the timeline to replace oil with alternatives. The average guy is just clueless. They think we'll all be driving electric cars in 2-3 years and we won't be using oil, and therefore, why put value on long dated barrels? I take the opposite view, which we can get into in terms of the logic behind it. And so that's the goal. We can invest anywhere in the world. We are about 98% focused in Canada because that's where we're seeing the best opportunities today, the most discounted stocks with the best underlying fundamentals, the best rate of change, positively rate of change. And so that's who we are. And I've been doing it for a long time. I've got my fair share of battle scars. As everybody listening probably knows, it's been a challenging sector, but it really, really feels like we've got the wind in our sails this time.
Energy's doing pretty well right now, but like you said, it's been a bit rough for the past few years. Have you felt like a character from The Big Short once in a while?
Oh, it's been awful. Yeah, 2020 was like epically horrible. I don't know how many times I used the term soul sucking, but I definitely exceeded the allowable quota. But we've had to deal with so many uncertainties from economic hard landings, China hard landing, soft landing back in the day. We've had to deal with COVID, which was something unique that none of us could wrap our heads around quickly enough. We've had to deal with the rise of U.S. shale, now the end of U.S. shale, hypergrowth at least, pivots in OPEC strategy, the erraticness of President Trump and how he, basically swamped the market by lying to Saudi about how hawkish he was going to be at the time with Iran. So it's been a unique period in history to manage an energy fund, to be invested in energy stocks. And it's the reasons why, you gain through the hard times is when you gain your wisdom that you can apply to when times are better. And the runway that I look at, like I'm sure some people have read my stuff. Like I think we're in a multi-year bull market, which I define as at least 5 to 6 years. And so now is the time to utilize the lessons that came from losing money and pain and misery, and leverage that expertise to really try to put some points up on the board for my unit holders that are the most loyal client base I could possibly ask for.
I'm sure you felt like Dr. Michael Burry at times in the last few years. I'm sure there's moments where you thought you weren't sure when things were going to turn around.
Sure. Well, and there's times now where I stare at my screens, like my models, and it's like, how can other people not see what I see? Because to me, it is so unbelievably obvious. And so much of it is just arithmetic, common sense, and logic. And we won't get into company specific details, but I'll give you a flavor. Like, talking to a couple of trading desks this morning and they say, oh, we've got a seller of X losing. Like, does that person not like to make money? Like the stock's trading at 2.2 times cash flow. It's trading at a 28% free cash flow yield. It's aggressively buying back stock. They announced that they bought back like $150 million of stock the past couple of months. The CEO is a very level-headed, steady hand. They think they've got 10 years at least of drilling inventory, and yet they can privatize 2.5 times over from free cash flow at the current oil price before they have to worry about inventory. So it's just like, how can people, like I look at my targeted upside, which I kind of use multiples and free cash flow yields, and I see like 130% upside. Like how do multiple opportunities like that exist? They shouldn't. This should be an efficient market. There should be enough people rolling up their sleeves doing the work, and yet it isn't, because it's been a game of survivor. And this sounds like a bit of bravado, but within the Canadian energy space, we're down to 2 energy funds really that I consider myself to have one competitor, and he's a smart guy. They're a smart team. But my God, like this was and is a big part of our economy, a big part of the market. There should be more than 2 sector specific funds, but it's been a game of survivor where people have converted to ESG funds. They've went into tech. They got out. It's from the misery because they couldn't take it anymore. And so, I use the analogy is like last man standing. You're that guy in the rowboat, middle of the ocean. You see this epic storm coming at you. you can't turn back. Like you're screwed, right? So like, what's your choice? You strap yourself in. You just got to get through it, knowing that if you get through to the other side, you're the last guy there, and then you get all the spoils. And so, you know, we got through the storm. We've made a lot of money for our clients. I got a call, you know, last week, and it's an advisor. And he's calling to apologize and goes, Eric, I'm sorry, but we have to start selling your fund for one of my clients because he's up 1,000%, and now he's retired. And now he's retiring, and he was apologetic. Like those are, if I'm going to get fired by that client, like that's the best reason that I could possibly ask for. It's a very different conversation today than it was 5 years ago when people were saying like, not all like, what the heck are you thinking? Like, you know, things are imploding. Everyone's bearish. Like, what are you doing? Kind of thing. So yeah, it's much better days today.
How'd you get into investing?
I've loved it ever since grade 3-ish, which sounds nuts, but there was an organization that came into my school that ran a fake stock market for 2 days. And I thought it was cool. It's like a game, and everybody's kind of, you know, they made it a game. And it's not the worst analogy to use now, but there's consequences if you lose. But, you know, everyone's given the same cards, you know, everyone gets the same information, and it's how you interpret that. And if you can interpret it better, if you can see pattern recognition in this business is incredibly important. And so if you can see the patterns, you can make distinctions that others aren't, then you win and they lose. And it's a question of, you know, strategy. It's a question of pattern recognition, a couple different things. And so I just, you know, from there, I helped start an investment club in high school, which as a minor managing real money we had some our own compliance issues, which we weren't aware about at the time. That did okay. And then, you know, it just kind of spiraled from there. So I've always known that I wanted to do finance. Getting in energy was a bit of a fluke, frankly. Like I was hired by Eric Sprott and Jean-François Tardif, two very, very good managers. Back in 2003, they were bullish on gas at the time, so they wanted a guy to come in. I didn't have a clue what I was doing. They were patient enough with me to let me make enough mistakes to find my stride. And we launched the Sprott Energy Fund, which converted into the Ninepoint Energy Fund. We launched it in 2005, and it became the Ninepoint Energy Fund when we did a management buyout from Sprott in 2017.
Eric Sprott, I read, was one of your biggest mentors. What's the best advice he ever gave you in terms of investing?
Oh man, well, I worked with him from 2003 to when he partially retired. He's still going now. He's a self-made multi-billionaire, at least a billionaire, through investing, which is incredible. He's taught me so many lessons, and obviously the biggest one is be early, be bold, see how big something can be as quickly as you can, and you have to have conviction. And if you believe in your call, go big. Don't let the nattering, the noise, the Debbie Downers talk you out of the trade. So long as you're, you know, it's not wishful thinking. It's got to be based on logic and data, thorough analysis, but always see how big something can be. And so you can apply that today. Like there are certain plays where the Clearwater now, you know, I don't think people realize how good it is. And so there's a huge opportunity. And so I own about 14 names, all publics. I don't own one of the obvious privates to invest in it. But our three of our large top positions would be what I consider Clearwater guys, because I've got my analyst meeting with, you know, we think we know the play. He's meeting with all the technical teams over the next week, involved just to make sure that we do understand it. But here you've got a play where wells are paying out in 2 months. Like it's ridiculous. And yet I can pay the same multiple for companies that have the most economic play in North America. And because the market is so inefficient, I'm paying for the same value for that business as I am for a company with, you know, 6 years of total inventory that have higher declines, more financial leverage, and less competent management team. So that's how I would apply it. You know, he taught me so much, and I credit him for taking me on when I was young and was clueless, frankly. And you know, it's my turn, or will be in the future to return the favor. But you know, be big, be bold, have conviction, and see how good something can be as quickly as you can, and just keep reevaluating to make sure that you're not wrong. Like, don't look for confirmation bias, and you've got to be as disciplined on the selling as you are on the buying, but let things ride. And so we enjoyed names where like Taser, when I was a generalist analyst, that was a name that I found for Eric, and I think we made 32 or 33 times our money on that. And so it's just see the market, how big it can be. And my God, the guy never sold. If you want to talk about conviction manager, he wrote it all the way. It was incredible. So
Would you call that a value approach to investing in the classic Ben Graham style, or do you have a kind of approach you
I
take?
don't really have one. I've been called a value investor by management teams because there was a time when I wanted to buy value in energy. And Neil Rizal called me that one time because I didn't buy one of his companies, and it was a huge mistake. And the company went on to do well because I was like, well, Neil, I keep trading here, I can buy here.
Mm-hmm.
Like, what am I doing?
Mm-hmm.
And so in energy, you can't necessarily be a value guy because cheap stocks are usually cheap for a reason, and the market can be smart enough to figure that out. I would say it's not now, but you don't want to buy, like, I'll put up graphs on Twitter just trying to educate and inform, and it's really the greatest medium to communicate on a daily basis to my own clients, to remind them every day, okay, this is what's going on, this is how big it could be, these are the reasons to stick with the trade, not to sell too early, etc. But I'll put up a bar graph, and some people mistakenly think that you want to own everything on one end of the spectrum. You want to own the cheapest of the cheap, and that's not always the case.
Mm-hmm.
Like, there's different things you want to do. I really try to find value that the market is overlooking in names where it's not going to be a value trap, where there's an inherent catalyst, there's a story. People buy stories. So you want to find a story where there's a narrative, there's a catalyst, there are events that will make the market view it in a different way. Because if you view the stock in the same way, well, it's going to trade at the same multiple. But if there's a reason, if there's a new play, if there's well results, if there's a meaningful share buyback potential, something that changes the narrative, then the market can see it differently and you can get the re-rating. And so if you can find those opportunities, and there are many of them today, it's because the market is so inefficient. For the value of a stock picker today is just awesome. That's what I look for. So I'm not necessarily a value guy. I'm not paying some ungodly multiple because the stock is working. Like, that's the greatest recipe to lose all of your money.
Mm-hmm.
But it's digging, it's using logic, common sense, math, experience, subjectiveness at times, and just trying to do your best to navigate the waters and do your best for your clients.
In terms of energy investing, are there 3 or 4 variables that you would classify as more important than the others? For instance, maybe cash flow or debt or reserves or management team?
The first one is subjective, and it is absolutely the management team. I've learned, like, you can have the best rock in the world and you can have a bad management team, and they will screw it up every single time. They will lie to you, they will over promote. You can see that recently, companies with negative technical revisions at times, the chopping of inventory, non-alignment, where companies in the past have had performance warrants where they're coming due, and so the management team is going to make $85 million while they sell the company for what you think is a distressed price, because was it in your best interest or was it in theirs? And very clearly at times it's been in the management team. So there are names, and again, we'll not get company specific, but
Mm-hmm.
they're just on my no-fly zone. I don't care if the stock's trading at 1,000,000% free cash flow yield, and they can privatize with 2 days of free cash flow. Like, if the management team is not trustworthy and I don't like them, I don't do business with them. And I don't want it to be personal, but it needs to be at times.
Mm-hmm.
Secondly, like, leverage is not an issue. Like, at the current oil price, nobody has a balance sheet issue. The sector could become debt free with 3/4 of free cash flow. It's unbelievable. You'll want to look at inventory depth, because you can't just say, oh, 3 times is cheap. Well, do they have 30 years of inventory, or do they have 3? If they have 3 years and they're paying 3 times, it's not that cheap. So you've got to think about that. The attributes of, one of my filters now is does the management team get it in terms of the necessity to return a meaningful free cash flow back to the shareholders? Because that's the curative for the apathy that generalist investors are still kind of stuck in. They're getting dragged back into the trade, but they're kind of still stuck there. And so I need my teams to recognize the necessity of returning meaningful. I mean, when I say meaningful, I mean at least 50% of free cash flow back. Ideally now, I want a base dividend and the rest going towards buybacks, given distressed valuations. There will come a time when, I think we've got more than 100% upside left in many stocks. That's my average for the sector, but 122%. When we get there, we'll still be in an environment, I think, of low to no growth, and yet high oil prices, so they'll be flush with cash. And so I will want them to pivot from buybacks to meaningful dividends,
Mm-hmm.
but we're not there yet. I think we need to double or more, re-rate from, we're trading at 2.9 times enterprise value to cash flow at $80 oil relative to historical context of 7 to 9. I'm using a target free cash flow of 10 to 15%. That seems like a very reasonable place for these companies to be able to get to. And so that was a very long-winded answer, but that's what I look for: management, inventory depth, the willingness to return meaningful cash back to shareholders. And then you can talk about, okay, valuation is obviously important. If you can get two identical companies, one you're paying 2 times, one you're paying 4, and everything else remains equal, obviously you want the 2 because you've got more implied upside.
In January of 2021, you bought, I read, about 50 million shares of Athabasca. So at the time, it would have been trading around 20 cents. Now it trades around $1, I believe. That must have been one of your best trades.
Yeah, we made 633%. We paid 18 cents. We bought 53 million shares, so 9.9% of the company off of Equinor, Statoil. And we did it because at the time, oil was trading at 53. And so I'll apply the lesson that Eric Sprott taught me. It's like, okay, well, I had the experience to know, okay, their stock here, it's probably non-core to them. It could be quite core to me. Oil's at 53. Do the math, and I had their free cash flow going up 10 times if oil went from 53 to 60. And at the time I was very public, and I said, well, I think we're going to see $60 by the summer and 70 by the end of the year. And even that was too pessimistic, even though at the time it was, kind of an outlier call. And so, it's an example where you've got to be early. I was literally, so I approached one bank. I bid them 15 cents, they passed. I wasn't aware that at the time another bank was actually working on the file. So they called me because they knew that I'd probably have an interest. And I was the order. Like, there were not many other guys in that. So literally at the time, and this is a big bank that did it, there was not another investor in the world that wanted to buy that stock other than the guys that were intending to flip it. That's my read in terms of the book. So the lesson from that is be early. Base your investment decision on logic and modeling, but see the opportunity. And that seemed like I thought if I got it right, I was paying about 1 times free cash flow for the name at $60. And there were risks to it. I could quantify it. I had an exit strategy if we were getting to that risk event and it wasn't coming to fruition. And management got the job done. They got their refinancing across the finish line. And, it got to a point where it went from distressed valuation to in line. Still see very good upside for the stock as I do for the whole sector. So, I said on BNN last week, like, it's not a permanent, position for me, never to own the stock again. Like, every day is a new day. So it felt like the right call at the time.
Was it, did you have trouble going to sleep that night, or was it an easy call?
The buy or the sell?
Yeah, good question. The buy. How about the buy?
The buy was actually very easy, and I was really excited because I really felt that I had stole it from them. And you never know, right? Like, it's the benefit of hindsight, right? Here I can say with bravado, like, we made all this money. There was risk at the time, but you've got to look at the risk and you've got to look at the potential reward. Weigh those two, evaluate the risk. Is it reasonable? Is it not? What's the timeline? Do you have an exit strategy if you need to, etc.? And then we could very easily quantify the reward. So, like I said at the time, I thought this could be a 10x stock. Well, we didn't hang on for the full 10x. I still think that's possible. But yeah, 633%. Like, we made, I think it was $62 million net gain for our clients. So that was in the win category for last year for sure.
That's incredible. Managing money is very hard. It's maybe easy to do well 1 year, or next year you'll do well, but over a 10, 20-year time frame, it's incredibly hard to outperform the markets. How many people do you see consistently outperform the markets?
Yeah, not many. I only focus on energy. My record on after fee is pretty decent outperformance relative to the index. The guys that would throw rocks on Twitter and whatnot would say, "Oh, geez, your 10 numbers awful." Well, yeah, it's not glorious relative to Apple and Facebook. But it's been a tough spot. So for a sector that's gone through massive challenges, I feel proud about the performance we've put up on the board relative to the challenges we've had to endure. And if I'm pretty optimistic about the structural bull market that I think that we're in now, and it's gratifying to see more people joining that call. Like, it's becoming more consensus. But what's shocking to me is it's still such an under-owned sector. I was chatting with a master at RBC, he's the energy trader there, really good guy. And our challenge is, when my fund's up 27%, whatever year to date, it was up 187. You're like, Jesus, should I be taking risk off? Should I be, because we've screamed higher. And the conclusion is what you should be doing is sitting on your hands, because it is such, in my opinion, because it is such an under-owned sector. We've achieved all of that we've achieved. And the generalist large institution is not here. And if they're here, they own C&Q, Tourmaline. Maybe if they're feeling risky, they're going to own Synovus, right? But they don't own what I own. And that's where the greatest opportunity lies. And so I still think, like, I was asked on another speaking event yesterday, to the baseball analogy. And I don't, they say, oh, what inning? I don't even know if the players have taken to the field yet. I don't even know if the game's really started. I wrote a column for the Financial Post last year, and I used the analogy of a party. So for a long time, I felt like the guy that showed up to the party 2 hours before, and I was expecting like a rager, and instead the host opened up the door in her house coat, and the champagne was still chilling. Well, the party's going, the music's going, but we truly are still waiting for that guest of honor, which is the large generalist fund manager who is terrified about getting fired by his clients because he is underperforming. Given the outperformance of Energy, the dramatic outperformance of Energy this year, I can't imagine the performance anxiety that they would be suffering. And all of the feedback I get from the desks are those people are now coming back. And so it takes them time to establish weights, establish positions. I think most generalists are still underweight this sector.
So in a nutshell, it's not too late for the average investor to get into energy.
No. So I would say that, the average Canadian energy stock's probably discounting about $60 WTI right now. We're trading $88 barrels right now. I think we're going to potentially see 100 by the end of this year. And that feels like a pretty good level for the next couple of years. And I can back that up in terms of the global inventory levels. They're approaching levels last seen in 2010, 2014, when oil averaged $97 WTI for a 4-year period. We were perverted into thinking that's a high oil price by US shale, which was a failed experiment that suppressed the oil price for a period of time. And that was financed by the high yield markets and equity investors who lost like $1 trillion by doing so. And so the road forward, when we look at continued demand growth and guardrails on supply growth, that feels like a reasonable place to be. And so if you're buying a company discounting 60, you're getting not just upside on where we already are, meaning 88, but obviously you're getting free optionality on 100 and what I ultimately will think would be an all-time high oil price. I use the analogy, and this is the greatest way, because I've got some graphs. My favorite graph that I've ever made is a bar chart that shows how many years of free cash flow would it take for a company to privatize and become debt-free. Mm-hmm. And the power of that is it was meant to sterilize the concern of a prospect or potential client, because I deal with advisors and then they have their clients. And we've got, a lot of clients all across the country, predominantly in Canada. Mm-hmm. But, ESG worries, electric cars, I hear government wants to decarbonize, et cetera. And they would say to the advisor, like, it sounds great, but I don't know what demand looks like in 5 years. So how can I buy an energy fund? So what I wanted to do is have one tool, a picture, a story to tell that completely destroys that concern in 2 nanoseconds. And so if you look today at $80 oil, the average company can privatize and become debt-free in 4.7 years of free cash flow. So that's at 80, that's $8 lower than where we are today. Mm-hmm. But on average, the average Canadian company is sitting on about 15 years of drilling inventory. So I use the analogy of, forget it's oil because there's emotion attached to it. Let's just be pragmatic, non-emotional investors. You have a business that makes widgets, and they have 15 years of widgets sitting in a warehouse today. There is no risk. They are there. The sales price of widgets today, it's gone up, but I think the price is going to go higher. But it's such an awesome business that the margin of selling widgets today would allow that company to take out all of their shareholders and to pay off the banks with 5 years. But they've got 15 years of inventory, meaning I'm getting for free today 10 years, 50 minus 5, I'm getting 10 years of widget sales, i.e. all of the free cash flow that goes along with that. Well, that represents about a 40% dividend yield every year for 10 years. That's a 400% return. And the market is putting zero value on that. So in terms of the potential income that you can get from the sector, and so you'd ask the question, well, how is that possible? I've said earlier, like, I still look at my models and like, how do more people not see what I see? Like, it's logic and it's math. And it's because of, again, energy ignorance. The lack of knowledge, even in Canada, we have the third largest oil reserves in the world, and yet the average Canadian is completely clueless in terms of how do we use oil. And the flip side to energy ignorance, so the other part is the likely time frame to displace oil with alternatives, so electric cars, hydrogen, renewable jet fuel for aviation, etc. And if you spend a few minutes, and on my Twitter feed, I've got a video that I did in October, and I talk about it every time, so just pull up any video. There's even one I did with Catherine Murray and then the Financial Post 2 days ago, and I touch on it. I think it's the Catherine Murray one where I go into detail. And you just spend 5 minutes, and you'll come to the conclusion that the demand for oil will grow for at least the next 10, 15 years, at which point I think it will only slowly moderate. But the question I would ask you is, well, what happens to the oil price the day after we peak? The day after oil demand peaks, what happens to the price? The average guy will say, well, geez, it goes down, right? It implodes. We're not using this stuff anymore. But people forget what makes the price of anything. It's not just demand, it's also supply. And there's a line that I've kind of coined now, and it is the fear of peak demand is leading to the reality of peak supply. So fear, it's corny to say, but it can stand for false evidence that appears real. So all of the noise that we hear, electric cars, and I hear there's a pilot project to use cow carcasses to convert into, biofuel to burn in planes. And I hear, Vancouver, they've got an electric plane. Like, all of this noise makes people think that the end is nigh for oil, and this is a sunset industry, and therefore, I don't know what demand is 5 years. So as a board of any oil company in the world, why would I sanction big, large mega projects that take 4 to 6 years to come online and another 4 years to reach project payout? That's 10 years. I don't know what demand looks like 10 years from now. So I'll take the path of least resistance. I won't fund projects. I'll pay down debt. I'll get banks out because they've been bad actors. I'll increase dividends. I'll do share buybacks. I'll invest in ESG, renewables, etc. And so when the day comes that oil demand peaks, if people are unwilling, and if companies are unwilling to invest in new production today, what will be their willingness when demand truly is on a slow, gradual decline? My guess would be the willingness is even less than it would be today. And so I think we can reach peak oil demand, and yet the oil price continues to rise because supply continues to fall faster than the demand. And that will blow people's minds. And so for all of the good intention government policy in Canada, we need to transition and we need to pivot. My God, the oil workers, it's sunset. We need to help them and et cetera. We have to take a guy making $150,000 a year and give him a $40,000 job, and he should be happy because, we're not going to need the stuff anymore. There is such profound implications of what I just said on how our government can be doing a much better job. And I need to keep this very apolitical because I'm not running Nuttall Asset Management. So there is wisdom, or there are implications of what I've just said for the role of Canadian energy in the world going forward, the lack of awareness of how good of a job we do on environmental standards. I put up on Twitter today, like, there's a floating platform ship that just exploded in Nigeria, and so we're worried about hummingbirds, and you've got things blowing up and leaks and people, unfortunately, being hurt by it and getting killed. And so if we cede market share in a world where demand will continue to grow, we give it to bad actors who have a fraction of the standards that we have as a country. And I really implore Canadians to wake up to that. And I do my best through the Financial Post columns and BNN, et cetera, but we need more champions to discuss how crucial our sector is to the Canadian economy, the ability for it to pay massive, not just royalties, but now cash taxes that fund our schools and our hospitals and our roads, and to dig us out of our $1 trillion hole that you owe and I owe and my kids owe and their grandkids are going to owe, and it's unbelievable. And so there's I've used the term again, people are stuck, Canadians are stuck in this catatonic state, and they're just not willingly listening. And so I'm hoping that as the clouds of energy ignorance part, whether it's going to take an energy crisis like we're seeing in Europe, whether it's going to take $150 oil prices and extremely high gasoline prices, and you throw on the carbon tax and such on top of that, whatever it's going to be, there will be a moment where collectively we all wake up. And so, anyways, that was a long ramble.
That's, I don't think you could put it any better. Also, cars are only, you mentioned cars, they're only, what is it, a quarter of what oil goes into?
27%. Yeah.
Like this, for instance, my water
There you
bottle.
go. So that's 40%. So 40% of oil demand is non-transportation, plastics, lubricants, petrochemicals, power gen, to a small segment. So that's 40% of oil demand that grows with population growth and living standards. And the world's population is expected to grow, according to the UN, by 32%, 2 billion people between now and 2050, which is that magical date that we need to hit net zero. And yet the population growth, it's not in Canada, other than immigration. It's not in Japan. It's not in the United States. It's in the Middle East and Africa, where on average they consume 5 barrels of oil a year. We consume 20, because we have living standards that, should people forget it a lot of the time, we have a living standard that most people, we're the envy of the world. We forget how good we have it. And so as the population is growing in areas where their energy intensity is low and will grow as their living standard rises, tell me how that 40% of oil demand is going to fall. The only way is we tell them, you can't have what we have. You can't do what we do. You can't fly like we fly. Good luck having that conversation.
Or the bad actors will fill in the gap.
Absolutely.
Yeah. Well, in a nutshell, it all wraps up into a compelling investment opportunity.
Yeah, I've used the word generational opportunity. I used that through 2020, 2021. We're up multiples from the lows, but when I look at it, the ability, I think, and this is just this is math, arithmetic, and if I'm right on the commodity price, then so it's an if-then statement. But if I'm right that the oil price could go to $100, if not higher, then I look at, okay, what's fair value for a business with 15 years of widgets? So I kind of think 10 to 15% free cash yield is a reasonable place to start. Then the math would suggest that, there's still a double or more left in many of these companies. And, the only reason why, again, it goes back to the theme, which I kind of coined and I'm really, really happy with, and that's energy ignorance. And so it's incumbent upon those who are aware to try to educate those that are not. And from an investment perspective, the low-hanging fruit is multiple re-rating. You take a stock that used to trade at 9, it's now trading at 2. So you pull up any 10-year chart, and I did this recently for a number of names, and they've fallen from like 40 to 5. And it's like, well, the oil price in Canadian dollars today is higher than when it was trading at 40. Now it's trading at 5. So it's not the oil price. What changed? It's the perception of the value of those barrels, not today's barrels, but the longer dated barrels. And so the reason why I spend so much time on the energy ignorance theme is that it's the lowest hanging fruit for a fund manager to make money for his clients. Because as soon as people realize we're going to be using oil for the rest of our lifetimes, suddenly those barrels consumed beyond year 2, 3, and 4 are valuable, and you should put value on that. And that's where I think we get a re-rating. And it's the reason why I think I'm being conservative in what energy stocks will ultimately trade at by the end of this cycle. But I always want my management teams to set low expectations and exceed them, and that's what my philosophy that I try to use with my own clients. And so, yeah.
You back all your demand, supply, and calculations, asset values, and everything else up on numbers. But like we were saying, how much of your investment ideas are based on psychology or kind of the intangible factors like energy ignorance?
I can't quantify it. So what I do is, our compass is, I have every company modeled out between 60 and 100 in terms of cash flow, free cash flow, what I think it's worth. And so in real time, I've got a bar chart with every oil price, implied upside per name, and it moves in real time. And so that allows me to make sure that I'm weighted in the names that I like most. Now, we spoke earlier, you just can't buy the most upside because there's different attributes to every story. So I need to ensure that in each of those bars, there's stories. Is there something there that will make people see the company differently? Is it a buyback? Is it the monetization of an asset? Is it a new play? Is it the potential to do a meaningful buyback? Is there a well result, etc.? So it's there, I can't really say I can't
Yeah,
quantify, but
exactly.
part of it does come from, and I've been doing this for 19 years now. So in energy specifically for 17, give or take.
Mhm.
So you over that time frame, you hopefully have learned from a whole lot of mistakes, because I still make mistakes often, as everybody does, but the goal is to learn from them. So I've got enough wisdom now, I hope, to be able to apply that to not repeat mistakes, and use that wisdom in what I think is going to be at least a 5 to 6 year bull market for our sector.
It seems like a lot of the best investors don't just sit in front of their spreadsheet all day. They, like Warren Buffett just reads all day, for instance, or considers a lot of things when they're making their best investments, and it's not just a strictly number crunching game.
Yeah, well, for a sector, you need to have a command of what's going on, in the global economy. You need to figure out oil. Okay, I don't have an MBA, nor would I ever get one, but it's like,
Yeah,
MBA. Let's do a SWOT analysis, and what
right.
are the competitive threats to oil, and strengths, weaknesses, blah, blah, whatever the heck the A&T stands for. But it's
Mhm.
just like, figure out what are the competitive threats to oil, and just dissect it. Okay, hydrogen. Let's talk about it. How many billions of dollars? It's going to be a commoditized, low margin business. Who's willing to do without government support? And if they get government support, what's the time frame? What's the scale? What's the quantum? How long does it take to scale to replace 18 million barrels per day of diesel demand? Electric cars, there's 1.3 billion engines to replace. EV sales were 5 million last year. The 1.3 is growing every year as the population grows. So yes, the 5 million is growing, but how many years of sales of 5 million that's ramping does it take to displace 1.3 billion that's growing, et cetera? So you just have to use logic and common sense. And I find, as an investor, those are two things that people don't employ as much as they probably should. They allow fear to govern their decision making. And again, I can sit here with the benefit of hindsight, but 2020 was horrible, like for all of us. We all in different ways were walking through our own, valley of deaths. And we were it was like we were climbing Everest, and we were in the death zone. We were above that level where if we stayed there, we were all dead, because we would be
Mhm.
starved of oxygen. Companies were being starved of cash flow, and we all remember how bad it was. But our goal, my goal is, put that in the past. Other than the lessons that I learned, the emotional fortitude that it helped build. And so when you get a little correction, a 5% pullback, it's like, I saw Cenovus fall 50% in a day.
Yeah.
This is nothing. Did my thesis change? And if my thesis hasn't changed, it means the stocks got cheaper. And I've been accused of being a permabull at times, which I completely don't agree with. But there are times to be bullish, there are times to be bearish. And so if your thesis hasn't changed and stocks got cheaper, then it's incumbent upon you to take advantage of that.
You remember the day oil went to $0 and even negative?
Yeah, I was doing a webcast, like a Zoom call with clients, and we watched it together in real time. So
Wow.
I'd have a video on my Twitter feed, because we're approaching the 2-year anniversary, I guess.
Yeah.
I've got a video. I don't think I nailed the 47, but I think I nailed it when it went negative. Yeah, unique period of time that hopefully we never repeat. Trevor,
You,
I've really enjoyed spending the time with you.
I appreciate your time. To wrap things up, what advice would you give to the average investor, maybe looking to ride the energy wave or just in general?
I would say ignore stock charts, ignore the performance columns. Even when you're looking at a fund, ignore the 1 year, 2 year, 3 year. Evaluate what a company looks like today using what you think is a reasonable commodity assumption. And the reason why I say that is I put up a tweet. I won't mention which name, but I bought 1 million shares of a company at 29 cents a share in March of 2020. So, $209,000, whatever, it doesn't matter.
Mm-hmm.
Last week, I bought 1 million shares of the exact same company, and I think I paid $9.05. So it's gone from 29 cents to $9.05. What I paid for that business, it was less with the $9.05 purchase than it was with the 29 cents. The risk, in my opinion, that I'm taking on with that $9 purchase is less than I got with the 29 cent. So you can't fool yourself out of making what I think is going to be, still a huge opportunity by staring at where stocks have come from. Like that's, I've said, like, people try to time a market bottom. Only an historian can ever do that, because you never know. So you just have to evaluate, does it sound like a good opportunity when you can buy something for nothing, when stocks are discounting an oil price $28 lower than where we sit today? Some guys think we could go materially higher than that. And you just have to drown out the noise, especially for energy, because remind yourself that the only people that benefit from high oil prices are oil producing countries and energy investors and oil companies. Nobody else in the world benefits. And therefore, there's a bias everywhere to talk energy down, to talk up transition. And that's noise. It's like just nattering in your ear, that if you listen to it enough, that will impact your decision making. And I think it will talk you out of the trade. Like, I've had to deal with the whole EV nonsense for 5 years, and here we are still today. So just tune out the noise, try to block out the fear. When you feel like throwing up, which there were days 2 years ago, those are typically when you should be buying. It takes discipline and practice, frankly, to be able to do that. It's easier said than done. But the biggest thing is look to where stocks are going, not where they've been. And don't look at the year to date. Don't look at the 1 year columns. Try to figure out, okay, if, let's just use $70. What's the value of the company worth? How much risk am I taking on relative to what that would imply in terms of the upside?
Well, I think that's a great place to leave it. I really appreciate your time.
Happy to spend the time with you.
We can wrap things up there.
Awesome.
Thank you very much.
That was good.